What's up everyone? So in this video I'm going to be going over a few basic things on how to plan a session, how to execute a session, and how to be on the right side of the market. So this is a trade I took today, so 25th of September. So my execution here was at around 20 past 10 EST, 66.63 with about a 8-point risk with this much reward. So obviously that didn't get hit, so I'm going to go through the entire trade. Okay, so when we come into the markets, we want to understand three basic things whenever we're trading, right? We want to know where to trade from. So we need to have a key level. We then need to know what to look for, which is buyers and sellers, nothing else. And then we need to understand fundamentally why we are buying or selling, right? It is that simple. So if we just take a look at the market, so pre-market, we had a very, very large sell-off from, London session going into the start of the New York session over here. So 9:30 Eastern was here, right? So a couple of things I want traders to pay attention to when we're looking at this is, first of all, we had the sweep of the previous day low, right? So if we've had a sweep of the previous day low, typically those who've been trading ICT concepts or any type of concept, when you see a sweep of the previous day low, this is what gives us the best buying opportunities, right? So this here is a sweep of the previous day low. And now from here, this is essentially how you want to be trading. So you're looking for a key level entry off here to take it long. This is the fundamental basics of forming a key level, right? So if you struggle to form a key level, always look at where the previous day high is. So I'm just going to previous day low. So I'm just going to label that PDL, previous day low. So that's the first thing. The second thing now, when you're looking at this, we want to use the daily or the weekly opening price. So in this case, I'm going to use the daily opening price because the daily and the weekly are both in a similar-ish position, right? So if you look at the weekly opening price, we are here. So this line here is the weekly opening. So I'm just going to write WO. This is the weekly opening price. And now from here, if we look at the daily opening price, so we want to use a New York midnight opening price. So for those who haven't had any kind of concept of the way the PO3 works or how I use the PO3, the power of three is overly complicated, but it's a simple concept. You want to be buying below the daily and the week or the weekly opening price, ideally both. So when you're in a situation like this, we're just stacking confluences in our favor, right? So we're below the previous day low, that's number one. We're below the weekly opening price, that's number two. And we're below the daily opening price, that is number three. So we have three things to look for in positioning our trades, right? So step one is identifying a key level. So how do I form a key level? So for me, a key level is simply the last 15-minute fair value gap. So this is the 15-minute time frame. And so if we just take a look, so if I go to the Discord, I'm going to break down the plan for everyone. So here was the plan. So I've got the same things out. So we have the weekly opening price, we have a key level from the previous day, we have these two key levels from the previous day. So what we're looking for here is we're looking for this key level over here. So this key level, this was the market opening. So this was 9:30 Eastern, the first 15 minutes. We're looking for a 15-minute opening range breakout. We're looking for a 15-minute break. That's the only thing we're looking for here. And we derive it off a 15-minute fair value gap. So what that means is if we break above this level, we are long. If we manage to hold this level, we are short. So the reason why I was looking primarily for longs in this position here was because of the things I've discussed earlier, right? We're below the previous day low, we're below the Asian range low, we're below the daily opening price. And so knowing how a daily candle forms is important. So daily candle will open, it will accumulate. This is all part of the manipulation phase. So the low of the day is what we want to try and trade away from, right? Using, principles of fair value gaps and order flow, which is the main bread and butter as to how you enter the market. But step one is identifying a key level. You need to have a key level in place if you're trading, right? If you enter the markets without a key level, you're setting yourself up to fail. So what makes a key level? Again, very, very important you get this right. We're looking for a 15-minute fair value gap. We want to be below the daily opening price or the weekly opening price. And we want to have taken out some kind of liquidity, right? Liquidity isn't a must, but it's definitely a good confluence. In this case, we have two spots of liquidity. Asian range taken out, previous day low taken out. So we have both of these liquidity areas over here. So this is what we would call a manipulation in price. So if I just label this, a manipulation in price is typically just the ICT Judah swing. So we're looking for this. This is going to be our manipulation or Judah swing. Now, when we come into a fair value gap, there's only two things that can happen. So from here, realistically, if you've been trading for more than 6 months, you will understand when we hit this level, we can either hold to the downside or we can hold to the upside. And this understanding here is the difference between trading and gambling. Knowing what's happening at your key level. So again, if we look at scenario 1, for example, what's going on in scenario 1 is we need sellers to be in control, right? And there's only one way to spot if sellers are in control, and vice versa. If we're looking for a buy, we want buyers to be in control of the price, right? So we can't predict the markets. We can only trade based off what the market shows us. Who is in control at your key levels, right? This is trading in a nutshell. But we're going to be going over a case study on how you could have caught this position. So for buyers to be in control, you need to see aggressive sellers failing, right? So we're going to be going into this and the execution that I had. So if we just get this out again, key level. So now from here on the 1 minute, we're going to go down to the 1 minute. I prefer to use the 1 minute for my entries. So the session itself was quite a rangy session. So this is why I kind of broke even over here. Wasn't able to capitalize on the full position. My TP was up here. But we're going to be breaking down how you can kind of catch these scalps on the lower time frames, right? So what we're seeing here is a very simple break and retest. So this is the break and retest. So we see price giving a break over here. Then we have a retest, and then we shot higher once, and then we shot higher twice. Now, for you to capitalize on these positions, you need to understand what's going on inside of the key level, right? So the key level itself, we're going to be focusing on a few areas. We're going to be focusing on this candle, because this is in the key level, and we're going to be focusing on this candle here. So I'm just going to label them in two different colors, in the same color, sorry. We want to focus on what was going on here. I want to label that in red. And we're also going to focus on what was going on here, okay? So these two regions give us the indication to go long at this level. And this trade particularly was only about a 1 hour trade, or depending on how you managed it. For me, it was only about 1 hour. Good scalp, but more importantly, it's good to understand what was going on inside of these levels, right? So this is where we use order flow. So my entry for this particular trade came at... If I just draw this out, so my entry was around this level. So this was around 19 past 10 or 10:19 Eastern. So we're going to be going over the price action inside of this key level. So there's a few things that made this a good setup, or an A+ setup, right? So first of all, what's happening is we can see price peaking above this level, and we broke above it once, but we officially had a break over here, right? So what you can see is strong green candle, but more importantly, buyers are inside of this candle. We see aggressive buyers breaking above the level. What's interesting here now, this is why order flow is my favorite thing in the world, right? This is why I, love making videos on order flow. This candle here, what I've highlighted in red, is the same as this candle here. Now, so I'm going to zoom in. What this candle is showing you on the order flow is it says 1K for 404. So this is 1,000 for 404. So here we have a green candle. So a green candle, we know by definition means prices are going higher. We see higher prices. Now we see higher prices, but we see 1K for 404. So what this tells us is that there's more. So we all know that this is the bid and the ask, right? So bid and the ask is the only information you need to buy and sell. So if you're unaware of what the bid and ask is doing at key levels, then you have a strategy problem, not a psychology problem, right? Because this break and retest was not hard to catch. You had to be patient, but patience is only as good as what you're looking for. So if you're looking for a market structure shift or a fair value gap, those things aren't going to serve you on the lower time frames. So what you need to understand is the interaction between buyers and sellers, who is aggressive, who is being absorbed, and why price is moving up the way it is. Why did price move up? Why did price reject and go higher? This is what we're going to break down, the why behind the trade. So what we have is we have a key level. So we have our where to trade from. That's a key level. We've now established what we're looking for. So we're looking for buyers and sellers, and the last thing we're looking for now is why. So why do we want to buy? We want to buy because buyers are in control. We want to buy because buyers are in control. It's that simple, right? Without knowing that buyers are in control, there's no way you can actually figure out you cannot trade without knowing if buyers are in control, basically. So now when you see 1K for 104, what this tells us is that we have something called a delta, right? We see a difference between the left number and the right number. So the way you calculate delta is simply by subtracting the right number from the left number. So you have 404 minus 1000, which I'm going to approximate to be about minus 600. It's about minus 600 or minus 596, right? So we have quite a significant negative delta, right? So this is important, right? This is important. So if we just go back to the order flow, we see that via a delta outlier. So you can see there's a very, very dark red row over here, which says 1K for 404. The reason that's important, and the reason that struck out to me in the session, was that inside of the key level, there is a very, very large aggressive seller that wasn't being rewarded, right? There's a large aggressive seller which hasn't been rewarded. This shows you that buyers are in control. So what I mean by that specifically, if I just draw a diagram over here showing that, if we have a key level, let's say we have a key level like this, I'm going to label that. So let's say we have a key level, we want to decide whether it's a support or resistance. So when we come into a key level, we don't know if it's going to be a support or resistance, right? We have no idea. So let's say we come into the level like this. Now, if we break above and we retest like this, right, we don't know if it's going to be a support or resistance. The market leaves clues on what it's done in the past. It's our job to read those clues, i.e. read price action, and then make a decision based off what the markets are showing us. So we're reacting to what the markets are showing us. We're not trying to predict anything. So psychology in itself is overrated if you're trying to predict the market, right? Your job isn't to predict, your job is to react. So if you're trying to predict, you have a strategy problem, not a psychology problem. So you can have the best psychology in the world, you can be patient, but if you don't know what you're looking for and you don't know what to be patient for, it's difficult to form an edge. So in this case, we had the negative delta, right? So here delta was minus 600, which means there's more aggressive, just going to write AGG, more aggressive sellers. Now, if you think about it like this, if there's a lot of aggressive sellers here and we shoot up above the level like this, so let's say we shoot up above the level, what does that show you about all these aggressive sellers? So these aggressive sellers are what we call, they failed, right? They're trapped, they failed, they're being absorbed. So that is what we saw over here. So if you're trying to trade lower time frames, let me clear up the charts. If you're trying to trade lower time frames, you need to know where sellers are getting in, where sellers are getting out. So in this case, we see sellers unable to sustain lower prices, right? Sellers are present. We see a lot of aggressive sellers, but they're unable to break below the level, right? We break above once and we break above twice. So this is what confirms the break as being a strong break to the upside. It is being supported by buyers. So what do I mean by being supported by buyers? So what we see is we see these aggressive buyers, right? We see positive delta here, here, here. We see a lot of positive delta that is being rewarded with follow through. Follow through meaning we break above the level. What's also interesting is aggressive buyers are succeeding, but also aggressive sellers are failing, which means there's passive buyers propping up in this zone, right? So all these aggressive sellers over here, they've been essentially exhausted. They haven't been rewarded. They've been exhausted. They haven't been successful, which means that the zone itself is being supported by passive buyers. So this is what's important to understand. This is the fundamental shift I'm trying to make in the industry, where if you understand who is in control at key levels, you're less likely to blame psychology for not having an edge, which is the biggest pet peeve of mine having the industry. If you can read buyers and sellers at key levels, I'm not saying you'll have a perfect strike rate or 100% win rate. You never will. No one does. But if you cannot read buyers and sellers at key levels, or you're relying on anything else other than buyers and sellers, that is not a psychology problem that you're up against. That is a strategy problem, right? There is a difference between the two. So now if I clear the charts up a little bit, what you can see, I'm going to label this, is we see a passive buyer over here. We see a passive buyer, and that's what you want at key levels, right? So passive buyers are different to aggressive buyers. You don't see any passive buyers on the delta footprint charts, right? Passive buyers are for you to dissect and understand based on price action. So here, when you see a lot of negative delta and you see the markets moving higher on 2 occasions, that shows you the negative delta, or the aggressive sellers, haven't been rewarded in price, right? When they don't get rewarded, that shows you that buyers are in control. Now from here, we see the same thing over here essentially, right? So this is the second thing we're going to look at. So this is the retest. this wick here, this is the retest. And so I'm going to label that again in red. So why am I labeling that in red? So this is the level and your entry was just over here. So long position as we break above here. You can have your stop loss here or ideally below these wicks. And we did go for a 1-to-1, I believe, right? Just over a 1-to-1. Now, in order for you to get long at 1020, you want to understand your break and then your retest. So we're focusing on the retest here. Now, the retest is even more interesting, right? Because the retest itself is significant. Because what's happening here is we see a lot of aggressive sellers, right? We see 23 for 0, 271 for 29, right? 271 for 29, a lot of aggressive sellers failed to break below the level again. So what we see over here is we see passive buyers propping price up. We see aggressive sellers failing, which means passive buyers prop price up again. This is what indicates to us that buyers are in control of the price, right? And that is why we had the markets shooting higher the way it did.